This is Bazaar Morning Call, broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. Thursday morning, start of the beginning of the end of the week, if I can put it that way. I'm Prashant.
Love the perspective, Prashant.
You can put a positive spin to anything, Surabhi.
Absolutely.
Morning, guys.
Good morning. Morning. I think Nigel and I kind of in shades of white, pristine, waiting for things to kind of ease out, because yesterday we had a lot of choppiness, a lot of volatility in a narrow band. So let's see how today goes.
Actually, I was noticing the intraday yesterday. It was flat and dead through most of the session, at least on the Nifty, right? And at 240, 250, there was a rocket.
Yeah.
And the rocket, of course, was thanks to the big move that we saw in Reliance Industries. I mean, I think almost single-handedly, with a little bit of help at the margin from ICICI Bank and HDFC Bank, but it was Reliance all the way. I mean, I think about 60, 65 index point gain on the Nifty came through from just one stock, the 3% move on Reliance, and it all happened post 240. Till then, absolutely flatlined the way we started is how the session was going. Now, overnight, Qs are not bad. So there's not very much to take through on the dollar or the yields, etc. So not very little by way of change. But you got equities which were higher, especially the Nasdaq. You should take note, 0.75% up once again. So with what we've seen this week so far, I think US is now flatlined for the year. It was down 1.5% last week. This week it's basically gained by almost that much. You had some comments coming through, which markets so far have completely ignored. But, with some of these things, sometimes the reaction is a day late. So you had Fed's William, who basically sounded hawkish on the balance sheet. As I said, market was not convinced. I just like to read out the quote in terms of what he said. He said the FOMC said that it intends to slow and then stop the decline in the size of the balance sheet, which is basically QT, quantitative tightening, when reserve balances are somewhat above the level it judges to be consistent with ample reserves. And then the punch, he says, so far we don't seem to be close to that point. And this is essentially what was, of course, this is hawkish as far as the transition from QT going slow, then stopping, and then eventually at some point QE starting again. And like what we've seen, expectations of the first rate cut being pushed back. I mean, I guess this is Fed's attempt out there, putting its people out there, saying, well, don't get too eager and sort of don't make it too imminent in terms of expectations. This will be a long, drawn-out kind of process. Markets, for now, ignored it. Now, later tonight, in terms of just data and what things to watch, we'll watch, you get the US CPI numbers, which I think, as we've been saying, is the single most important data point this week. There are some of the margins say, well, it doesn't matter now, inflation numbers, because, the trajectory is set. If not nothing, you basically will have the base effect ensuring that inflation numbers, at the end of the day, inflation is the rate of change. That's starting to drop. But I think for now, this is still, I think, will be keenly watched. More on that later. Oil prices, which have been volatile actually last 3 or 4 days, they were down about 1% at just under $77 a barrel. Now let's just circle back to the levels here. Yesterday we were asking the question whether the market is going sideways or maybe even entering a bit of a corrective phase. Well, you always get something. Like yesterday, something was Reliance and that big move that we saw. So the Nifty, as of yesterday, took support of the 20-day moving average and then actually bounced. We need to see, and before I get to supports, etc., we need to see if we are able to get back to that 21,763 levels, which is the high that we saw. If that is not broken on the upside, then, I mean, those doubts will linger, whether this is a slightly more sideways downward kind of phase. So I think on the upside, the marker which will tell you that, I think it should be about 21,763. Now, supports for the Nifty will come in at two levels. One is the 20-day, which stands at 21,488. And then the low that we saw yesterday, which was below the 20-day, but which was 21,447. So pretty close by, 21,488 and then 21,447. Break of these supports, I mean, only if you get a break, a decisive close below it will take you down to about 2970, which is nothing but the 40-day exponential moving averages. I still think we are in a bit of a flux kind of a zone, a ranged kind of trading action without too much by way of definitive price action. Nifty Bank seems to be in a bit of a sideways phase as well. So we need to see, again, the negation. If the high of 48,382 is not broken on the upside, that is 48,382. Which is what the market needs to stay under if the market is to make the bears, stand a chance even. So that's the number on the upside. And on the downside, you basically will see the 40-day exponential moving average. I mean, if the break comes through, which is basically 46,720, that is, not very far away, but it's not very close either. So we'll see how things go. As I said, still a bit of a ranged kind of price action is what we should find ourselves in once again. The GIFT Nifty is indicating a 25-odd point higher start. Surabhi.
Oh, no, absolutely, Prashant. As commentators for us and market participants, we would want to see decisive moves on either side, right? But markets don't have to oblige. Markets can be in a range for long periods of time. Yeah. And after the rally that we've had at the end of the year, perhaps I'm in this January range. Who's to say? We could perhaps be in it for now. The one market that's in no range at all, by the way, is Japan. I just wanted to put that out. The Nikkei has hit a very historic level of 35,000 plus this morning. It's unending, the rally in that market. It was the best performing market of 2023. And while we are dithering and we've gotten into a range here in India, Japan knows no stopping, and that's up another 2%. Last time that index was at these levels, it was early 90s. Pretty historic moves in Japan. Anyway, coming back to the point over here, as Prashant mentioned, you had an uptick on all the key indices. Between 0.5%, about 0.7% or 0.75%, depending on which one you're looking at. Just to put the number in context, if you're going to watch for that CPI print, the expectation is in December, CPI is going to be at this level of 3.2% year-on-year rise and 0.2% month-on-month rise. And if we get a print of 3.2%, it'll be very similar to the rate that we saw in November. October, the pace of increase was 3.2%. November, it fell to 3.1%. And again, the expectation for December is that we'll be around that vicinity of 3.2% yearly rise in U.S. consumer inflation. The more exciting news really overnight was what everyone's talking about, and that is the approval to this Bitcoin ETF by the SEC. I must admit, I don't track the crypto market very closely, but this made me do that for just a bit. So what happens is that this, of course, stems from the fact that the US SEC lost that case to Grayscale back in August. And that's when the expectation rose that they will have to come out and approve the ETF. They've done that. Now, Grayscale Trust has Bitcoin holdings of about $29 billion. And this gets converted to an ETF. The expectation is that there will be others because the likes of BlackRock have already filed for products. But I want to just read out the statement from the US SEC. How should we read this when you've got to go between the lines? Is this an all clear for cryptos, blanket all clear? Perhaps, we have to take that with a pinch of salt. And I go to the statement. Today's commission action is confined to ETPs holding one non-security commodity, Bitcoin. It should in no way signal the commission's willingness to approve listing standards for crypto asset securities. Nor does the approval signal anything about the Commission's views as to the status of other crypto assets under federal securities laws or about the current state of non-compliance of certain crypto asset market participants with federal securities laws. It's still sounding a little hawkish. They're watching the space carefully, but you have the approval, and that got a lot of the other cryptos like Ether, etc., excited, 15% higher, Litecoin, and all of these other coins that were up and about, still are, by the way, this morning. So the crypto market's quite exciting. Back here for us, again, watching for the lows because we've been protecting the lows. No matter the volatility, the Jan range is intact on the downside. And we had that test of the 20 DMA on the Nifty, 21,450 thereabouts. So let's see if that continues. Yesterday, that last hour surge, if you thought it was FII money, well, actually, no, it was domestic money. And that's the picture, 2,000 crores on DIIs. FIIs were actually on the sell side yesterday. So that's also interesting. We'll watch for that. Of course, today it's going to be all about TCS and Infosys. Numbers come in after market hours, and the expectation is very feeble, flat trend on the top line to negative trend. And I thought I'll put the revenue estimates that we have here at CNBC-TV18 up for you. Down 1.8% for Infosys, flat for TCS. This is, of course, the best case scenario. The market really wants to hear the management speak. And if there's any indication that this is the bottom and they're seeing improvement in U.S. demand, we know what that will do to the IT pack. But for that, we have to wait for post-market hours, I guess. We have to just watch for the range, I think, as we start off, Nigel.
Well, yesterday, typical textbook stuff played out. The Nifty went to around the 20 DMA. Normally, when you hit the 20 DMA, either on the upside or the downside, it normally rebounds, in the opposite direction. And that's precisely what happened yesterday. So the Nifty defended the 20 DMA. Today, we have the weekly expiry that plays out as well. So that adds a bit of a volatility. Yesterday, we had the Nifty Bank that played out weekly expiry. And after a while, at least it didn't underperform by a big margin. Yes, it was up only around 0.3%, while the Nifty was up 0.4%. But it will see resistance at around the 20 DMA odd. Infosys and TCS, both of them come out with their set of numbers post-market hours. So tomorrow we'll have the tech pack that will be reacting to those set of numbers. What did the FIs did? Well, they added some mild short positions and they unwound some long positions. But they're in that vicinity. 60 to 70% is the long position that we've seen. I would actually like to see the short positioning go up, because if you can get a positive surprise coming in from one of these heavyweights, then that's what gives us a reason to move up. But for the time being, the shorts are holding around 37%. In an uptrending market, you want to see the nearest put see some writing, and that's precisely what happened. So the 21,500 put yesterday had a fair bit of open interest. The premium ended closer on 15 rupees. At the high of the day, the premium had moved to around 125 rupees, while at the start it was around 60 rupees. So there was a fair sense of writing being seen at that particular strike. And if you look at the goalposts of this market, you're looking at the 21,500 put on the downside, has more than a crore shares, that has the highest open interest on the put side, while on the call side, you have the 21,800. So for me, that's the goalpost, and I expect the markets to be in this 400-point range. 21,450 to 21,850 will require an additional trigger to break this range on either direction. So let's get to the levels then. 20 DMA on the downside, 21,488. Since I said that 21,500 put was seeing a fair bit of writing, and the premium moved from around 15 to around 100 rupees, that's the broad support level, 21,400, 21,450. On the upside, we've seen resistance at around 21,800, so that's going to be the level. The Nifty Bank, crucial. Yesterday, it defended the 47,000 odd mark. You wanted to defend that mark, otherwise we're in for a deeper correction. On the upside, though, the 20 DMA becomes an important resistance zone. Saw a bit of a relief rally yesterday, 120 points. That could be because there was weekly expiry as well that played out. But we'll have to keep an eye out on that mark. On the upside, for starters, the GIFT Nifty, I think, was suggesting some bit of green to kickstart trade. So we'll have a positive start, but we'll have to build on from there. But for me, the stock of the day is going to be Polycab. You have some negative news that came in overnight. Not cheap in terms of valuations. You also have high institutional holding. So we'll have to see how this one reacts, because yes, the stock has corrected from around that 5,500 odd mark, but this is going to be the stock of the day, and we'll be analyzing this one for you all through the day.
Absolutely, because what happened yesterday was that there's an official statement from the PIB, an official government statement from the tax department. They haven't named the company, but they're saying a wire and cables company where they've conducted searches. And that release says that there are unaccounted sales to the extent of 1,000 crores, and goes on to talk about a lot of other alleged irregularities. The company in the past has denied all this, but this is fresh information. It's in writing from the government. So let's see how the market reacts to it. Anyway, let's move on and get you the equity call of the morning. Surendra Goyal of Citi expects 17% year-on-year earnings growth, 12% EBITDA growth across the Citi universe, and an 8% YOY earnings growth, 10% EBITDA growth for the Nifty in the third quarter. Among sectors, he says the year-on-year growth is expected to be strong in autos, industrials, financials, that is non-lenders, gas utilities, cement, and it would be subdued in IT services, banks, and staples. He says key to watch is the bank NIM trends, auto demand, margin trends, and management outlook on capex, as well as rural consumption demand.
Okay, well, let's get you some money market views here. Parul Mittal Sinha of Standard Chartered Bank says that the USD INR inched lower on continued FPI inflows and moderately weaker US dollar. Going forward, she expects positive seasonality in the first quarter, continued inflows ahead of index inclusions to push USD INR lower. However, she adds, forex reserve build-up by the RBI is likely to lead to a gradual INR appreciation. She expects the USD INR to trade in a range of between 82.8 to 83.2 to the dollar in the near term.
On bonds, Parul says India rates moved marginally lower on continued VRRR operations by the RBI and reduction in SDL auction size. She says launch of Bloomberg's consultation for inclusion of India bonds in its emerging local currency index is incrementally positive. She estimates $3 to $4 billion of inflows likely if this inclusion indeed happens. Global rates, she says, in any changes in SDL auction size and budget expectations are likely to drive the market in the near term. She expects the 10-year India benchmark bond yield to trade in a range of 7.10 to 7.25% in the near term.
Well, we've got a lot of stock-specific action to track for you, so we'll just list down the stocks and then we'll get further into detail in the next segment. For the time being, running you through the list. Tata Motors, Ashok Leyland, Electra Green Tech, JVM Auto, Phoenix Mills, Bank of India, we have Kalyani Steel and Steel Strip Wheels. All of them will be reacting to positive news flow. While on the flip side, you'll have Polycab and Axis Gates Tech that will be reacting to negative news.
Okay, well, that's what's coming up here in terms of specific stocks. Ed Yardeni is president at Yardeni Research. He's joining us now to take some questions. Yeah, Ed, good to have you back on the program. Thanks very much for your time. There is constant pushback to, don't expect the first rate cut in March. Overnight, the statement on the balance sheet. So is this just the Fed trying to temper expectations here a little bit? Markets paying no attention.
I think so. I think you're right to ask the question, because the markets have been discounting 4 to 5 rate cuts this year, starting in March. And I think Fed officials would rather stay very flexible and stay restrictive as long as they can, because the worst case scenario for them is that they ease too much too soon and inflation makes a comeback. So as long as the economy remains resilient, which it seems to be quite resilient, I think the Fed's going to hold off on lowering interest rates too quickly. And I don't think we're going to have a rate cut until the second half of the year. I think maybe we'll get 2 or 3 rate cuts, maybe.
2 or 3 rate cuts, maybe. And this is when markets were expecting 6 as we rolled into 2024. Ed, good morning, or rather good evening your time. Thank you very much for joining in.
Sure.
Let me ask you about the other development on the crypto side that happened. And I'm asking this because I want to know if it could potentially have any impact in terms of money flows from one market to the other. What did you make of this ETF approval? It was always going to come. I think that was the expectation. But then the statement seems to still sound a bit hawkish on this asset class as a whole. How do you read it? And do you expect any impact on money flows between cryptos, bonds, and equities?
Well, I think the government is kind of torn about what to do about Bitcoin. I think if they had their way, they would prefer no cryptocurrencies at all. It's certainly a competition for the Fed. It certainly provides a payment system for illegal activities. And so I'm actually quite surprised that they've gone this far in terms of, basically saying, giving their blessings to an ETF. But I think they're going to be monitoring it very, very carefully, as they should.
Hi, Ed. Morning. Good to see you, Ben. Ed, what do you make of the Asian market screen, though? India's done pretty well. Japan, out of nowhere, has come back, multi-year highs out there. And the Chinese market continues to struggle. How do you read the Asian markets?
Well, I think a lot of money that might have gone to China is going to other Asian countries, for sure. The Chinese market's been doing terribly because the Chinese economy is doing terribly. And I have a chart that one of these days maybe we can show on the program, which shows the MSCI for China versus the MSCI for India. And it's startling what a divergence there has been in recent years. So I think this clearly indicates that China is no longer viewed as a emerging market that you definitely have to own.
No, and we love to see that chart. Although I must say that that comparison is, I think a lot of our audience has said we've shown that chart in different ways, not the MSCI one, but it's remarkable, right, as you put it, over the last, and it's not 5 years, 10 years, it's 20, 25 years. Although, Ed, to that point, Akash Prakash, who's an old-time, he was ex-Morgan Stanley, runs his own fund, Amansa Capital, well-respected figure. He wrote a piece here recently, making that very comparison, but drawing a different conclusion. His point was that don't confuse GDP with what stock markets do. He cited the example of China. China was, of course, this economic miracle, and stocks have performed very poorly for 20 years, right? And he was kind of asking the question whether in India, growth will be strong for many years to come, but have we borrowed from the future in terms of stock market returns? Just your thoughts there, Ed, briefly.
Well, I think the prospects remain very good for India. It's clearly, compared to China, it's a much freer economy. It's a much younger economy demographically. And there's a lot of onshoring going on, meaning that a lot of companies are leaving China, looking for other places to do their production and their business. And I think a lot of companies went to China thinking that is market of over 1 billion people and they should be able to make a lot of money. but it turned out that the regulatory environment was very, very restrictive. And so suddenly, not suddenly, but over the past several years, people have come around to recognize that India is an excellent alternative to China. And that, again, China's got an economy that's probably structurally in trouble for a while.
Hey, all right, Ed. Before we wrap up, I just want to point out an update that's come in. Now, there's something we'll be talking about tomorrow because, we'll start getting a lot of the big bank earnings in the U.S. And this is
Yes.
just out. Citigroup has just
Yes.
given out an investor warning ahead of its Friday results that some of the charges that it has to take on, currency issues with respect to the peso and the bank's restructuring, they could be huge, far higher than what Citi had earlier indicated. Citi could report a
Right.
loss. That's not what markets would like to hear. And very quickly, as we roll out into the earnings season, I mean, overall on the U.S. market in the short term, are you optimistic? And how
am
are you viewing
optimistic.
some of these?
I am
So
optimistic.
expecting.
I think Citi's an outlier.
Okay. All right. I just had to get that clarity from you. Thank you very much for joining in. Good talking to you as always. We do have to take a very, very quick break on that note. We'll come back on the other side and get you our list of top stocks to watch this morning. Back in just a moment. Welcome back. So Asia is suggesting that we'll have a positive start to begin with. Let's straight away and distill this down to stocks and the ones that should be on your radar this morning. We'll start off with Parikshit. He's bringing us some policy news, some expectations on the e-bus side, and that could impact auto stocks today. Parikshit, morning. What are you picking up?
Well, this is definitely important because the government has been looking at having 8 lakh electric buses on the road by 2030. Now, in a bid to give a fillip to that plan, they are planning a de-risking fund to the tune of 30,000 crores, which would actually incentivize private banks, the private sector, to lend to companies, to aggregators who want to acquire electric buses. Till now, the government has found that lending to the private sector when it comes to electric vehicles or for acquiring electric vehicles has been very slow. There is reluctance on their part because of the uncertainties around the electric vehicle ecosystem in India and also around charging infrastructure. So in order to avoid that and cross that hurdle, they want to be a guarantor of loans to this sector. So this fund will serve as a corpus for acquisition of buses for the government, for PSUs, and as a de-risking fund for the private sector. So the government is in talks with the likes of SIDBI, several private bus aggregators, and this will also involve setting up of bus charging infrastructure. And the same de-risking fund will apply to the private sector who wants to set up private public charging infrastructure. And the same will be available for trucks as well. So let's see how this story comes together. There is a lot of discussion on FAME and FAME 3. Whether this will be a part of the FAME scheme, that remains to be seen.
All right, Parikshit, thanks very much for that. That's an important story from a listed universe perspective as well. And we'll try and get in companies to react to that. Thanks very much. Well, let's move on and talk about the other what's likely to be the big stock of the day, Polycab. The stock took a big hit day before yesterday. Yesterday barely recovered, nothing at all actually. And yesterday post-market hours, we had information from the IT department coming in and talking about what they found with their investigation with Polycab. We've heard from the company, but this is going to be important. Timsy is here with more. Timsy.
Well, that's right. The IT department actually came out with a press release saying that they conducted search operations in Mumbai.
Okay, I think that line is a little patchy, so we can probably just come back on Polycab. That's an important story, so we'll get a clearer line and go back to Timsy. But in the meanwhile, let's talk about Phoenix Mills as well. Sonal is standing by with more on this one. Sonal, good morning.
Good morning, Prashant. Well, Q3 was good for Phoenix Mills in terms of their operational update. They say that total consumption, that is the retail consumption, it has gone up by 24% on a YOY basis to come in at 3,287 crore rupees. Of course, it was, led by a lot of these new mall additions that have happened in Bengaluru, in Pune. And if we calculate on a like-to-like basis, the consumption is up 4% on a YOY basis. The company says newly launched malls contributed a lot to the consumption and they expect it to continue going forward. If we talk about their hotel business as well, their average room rentals have shot up in how? St. Regis, that one has seen a growth of 23% in room rentals, and the Marriott Agra property has seen a 9% increase in rentals, and this is not on the cost of higher occupancy. Occupancy is up just 1% on a YOY basis, but yes, good rentals and good consumption in both their malls and hotels business.
Okay, all right, Sonal, thank you very much for that. That's Phoenix Mills in focus. We are back to tracking some of these bank quarterly updates. Abhishek, good morning. You're looking at Bank of India?
Well, Bank of India has reported good numbers, especially with respect to sequential loan growth or quarter-on-quarter loan growth, which augurs well for its net interest margin, as the credit deposit ratio is the highest in last 8 years or even more. Take a look at the numbers. Deposits are up 6.7% YOY and about 0.9% sequentially. In this, the domestic deposit is almost flat on a sequential basis. Advances growth is at 11.5% YOY and about 4.2% sequentially. In this, the domestic advances are up 11.6% YOY and about 4.2% sequentially. So you are seeing an improvement in credit deposit ratio, which has jumped up to 79.7% versus 77.2% in the previous quarter. This CD ratio is the highest that you are seeing in last 33 quarters or even more. Domestic CD ratio nearly about 80%, 79.5% versus 75.5% in the previous quarter. Augurs well for net interest margin, which may improve or remain healthy for them. Back to you.
Okay, all right. Thanks a lot for that, Abhishek. Well, let's go back to Timsy. She's joining us to give us an update in terms of the searches on Polycab. Timsy, go ahead.
Well, yes. IT department in a press release last evening has mentioned that they conducted search operations in Mumbai at a group engaged in manufacturing of wires. Now, the evidences that IT department has got during the investigation is that they've got the modus operandi of tax evasion, which was that the flagship company has made unaccounted cash sales of around 1,000 crore rupees. Also, unaccounted payment of 400 crore rupees made by a distributor on behalf of the flagship company, and non-genuine expenses of about 100 crores have also been identified. Remember, very clearly, IT department did not mention the name of the company, but sources said that the company in question here is Polycab. Let's see what happens now. How does the company react to the investigation findings of the IT department? And yes, what is the final tax outgo that the company has to make? That is yet to be ascertained.
Going to be the stock of the day, Polycab. That's the one that we're looking at. Well, let's focus on Kalyani Steels. You know, for the last many years, every time the management comes on the channel, we have been asking them, what are you going to do with the cash in its books? Well, finally, I think for the first time in a very long time, I'm seeing it, at least last 5-10 years, I don't think I've seen them do any kind of, inorganic growth. But that's the big news that came in yesterday. They've gone ahead and they're the successful bidder for the acquisition of assets of Kaminini Steel. Now, this is a unit that has a capacity of close to 3.5 lakh tons, and they have bought this under the IBC route. The total cash consideration that they paid is around 450 crores. The management has told us, that they have adequate amount of cash. I think most of this will be funded via the cash in its book. So it's good news coming in for Kalyani Steel. The stock is up close to around 10% in the last 1 month. So maybe the street was expecting something on that front. But I think the street will like this because finally there is some utilization of that big cash balance that they've had.
Okay, that's Kalyani Steels in focus as well. With that, let's move to Vivek. He's watching out for a couple of names as well this morning. Vivek, good morning. Which ones are these?
Well, good morning. Well, the first company on my radar is Axis Gates Tech. Now, the company yesterday in a filing to the exchanges said that they're looking to raise funds via the QIP route. The floor price for this particular QIP, as per the SEBI formula, works out to around 696 rupees a share. However, we did access the term sheet, so sources tell us that this is a close to 300 crore fundraising that the company is looking to do, which implies close to a 12% dilution of the current equity base. The company plans to utilize the proceeds of this particular issue majorly for debt reduction and for working capital requirements. The second stock on our radar, it's positive as far as steel strip wheels is concerned. Now, from the Commerce Ministry industry, we understand that the DGTR, which is the Directorate General of Trade Remedies, has gone ahead and approved and recommended an anti-dumping duty on aluminium alloy road wheel imports for a period of 5 years. We understand that Steel Strips was one of the companies to have asked for an ADD for the aluminium alloy wheel. So watch out for Steel Strips. It could be at least open in the green as far as today's trade is concerned.
Okay, all right, got that, Vivek. Thank you very much for those stocks as well. Here's a quick recap of our list of stocks to watch this morning. The ones that have positive news around them are Tata Motors, Ashok Leyland, Electra Green Tech, JBM Auto, Phoenix Mills, Bank of India, Kalyani Steels, and Steel Strips and Wheels. The ones that have negative news flow around them are, of course, Polycab as well as Axis Gates. Let's move on and talk about some of the top broker calls this morning that are of interest that you should be aware of as well. We have Sudarshan joining in for the same. Sudarshan, good morning.
Good morning, Surabhi. So I have 3 stocks which are on brokerage radar. First one is HSBC on Bharti Airtel. It has downgraded the stock to hold largely on the rich valuation, but target is raised to 1125 from 1020 per share. It says growth drivers are intact. Average revenue per user will rise. Second, it's gaining market share in mobile. And third, growth in non-mobile and capex intensity will decline, but stock is fairly valued at current levels. Second is MS on Coforge. It initiates coverage with overweight. Target is rupees 7,200 per share, implying 17% rise from current level. As per MS, Coforge can keep its revenue growth profile higher for longer versus peers. It bakes in a revenue CAGR of 14.7% over FY24-26 on a constant currency basis. EBIT margin is seen improving by 190 bips over FY24-26, but valuations are at a premium, but it believes it has a potential to sustain. Last is MS on Manappuram Finance. It has an overweight call. Target is rupees 210 per share, indicating 25% upside from current level. It says SEBI putting Asirvad Microfinance IPO in abeyance had a negative impact as reflected in stock price move on Wednesday. But MS thesis is premised on undervaluation based on consolidated earnings. It sees average return on equity of 20% and EPS CAGR of 25% over next 3 years.
Okay, all right. Thanks a lot for that, Sudarshan. Well, let's go across to Manisha Gupta. She's going to tell us what's transpired in the commodity and the currency space overnight. Morning, Manisha.
Morning, Nigel, and thank you for that. Well, we have seen further decline come in for many of these commodities. It isn't very strong as a global environment as we see it, because you are looking at strength in US dollar index. The markets also will watch out for the US inflation data that comes in today, the China inflation and the trade numbers that come in tomorrow. So ahead of all of this, there's a bit of a choppiness that we have seen in the markets. I'll start with the crude oil prices, which still continue to trade below $78 a barrel. There has been pressure as we have seen rise in US crude inventories, and not just crude, the gasoline and the distillates also have seen massive builds up, telling you that the crude product demand in US also seems to be declining, and we have been facing that in much of Europe and Asia in any case, so that continues to weigh on. In case of metals, while gold and silver have been under pressure, but many of the base metal prices also have started 2024 on a weaker note. So whether it's copper, which is trading at a 1-month lows, on an iron ore, which is trading at a 3-week lows, well, almost everything in this week also is headed for a weekly decline.
Okay, well, Manisha, thanks very much for that. So that's commodities in focus. We'll take a quick commercial break here. We'll come back. Deepan Mehta of Elixir Equities will be with us with some fundamental stock chat. A little later, after that, we'll put the spotlight on more stocks, technical ideas, F&O trades, etc. as well. Stay tuned. Coming up.
Welcome back. You're tuned into Bazaar Morning Call. Well, we have listed down all the top stocks that we're tracking. Let's get some deeper fundamental analysis going. So for that, we are welcoming Deepan Mehta, Director of Elixir Equities, who joins us on the show. Hi, Deepan. Good morning. Well, let's get to the stock of the day. Polycab, the negative news overnight with regard to the tax department. and probable cash that could have been found, and various other question marks out there. How would you approach the stock? It could react negatively. And the problem is that valuation-wise, it was expensive. The street was factoring in EPS moving from around 80-85 rupees to around 150-160 rupees. So valuations, as it is, they didn't have any support out there. And now this negative news comes in. The other problem is institutional holding is 20%. What's your view on the stock? If you see a sharp downtick, will you look to buy or will you avoid it completely till the dust settles?
Good morning, Nigel, and thank you for having me on your show. I think I'll go with the last option. It's just let the dust settle. Typically, whenever such actions take place, there's a lot of uncertainty and the outcomes are unknown. Sometimes, it's just that company can explain afterwards, and it's not as big an issue as it appears to be right now. But for the time being, I think it's best to stay away. From an investor's perspective, I think anyway our view on the market is slightly negative. So, if you have position in Polycab, I would suggest lightening it up a little bit. And of course, fresh investments is certainly to be avoided. See, end of the day, Polycab was trying to make a transition from cables to a lot of the other electrical appliances, but that journey has not been completely over, or nor has it been to its true potential. And it predominantly remains a cable company with a lot of B2B business. So looking at the entire dynamics, I'm not sure we are prepared to pay a very high P multiple for a business like this.
Yeah, right. Dipan, just another quick counter question. Would you look at some other plays in the same sector, or do you say that, well, if the leader is having such an issue with regard to its B2B sales and so many question marks that are coming up, could it be a derating event for the sector on the whole?
No, Nigel, I think it wouldn't be fair to paint the entire sector with the same brush. And I'm not sure what the outcome of these particular searches are also. We have seen many such income tax searches in the past with various companies, but I haven't really, not one or two examples come to mind where significant action has been taken and the earnings have deteriorated as well. Usually there's a good explanation for these kind of, outcomes. So let's just wait and watch, and let's not just try the company in this manner and assume that there has been some kind of evasion.
Deepan, hi, good morning. The stock of the day turned out to be Reliance yesterday, right? With that sharp 3% surge. I think it made a new high yesterday as well. What are your thoughts on Reliance?
No, we've been generally very positive on Reliance, and it continues to keep on set up additional capacity across many businesses. Only, of course, the issue is that the return on investment remains low. But there's always hope that at some point of time, once there's a lull in the capex cycle and there's more productivity from the existing assets, that ratio also may move up. But the key question in Reliance Industries, as I always said, just remains on the demerger of the existing large businesses, retail as well as Reliance Jio, and the exact modicum or the medium by which they're going to do it, whether Reliance becomes a holding company or the shareholders get free shares of the other two companies. That remains the key monitorable as far as Reliance Industries is concerned. But large caps are in flavor and I think will remain in limelight for the next few quarters. So very positive on Reliance. And if you expect more FII flows, then I think Reliance and the likes, the large index stocks are going to be the first target for FII flows.
Okay, all right. Deepan, what about this electric buses theme? Stocks are just flying away. JBM Auto, you had Electra Green Tech. Electra Green Tech was surged away yesterday as well. How do you approach this theme, and what's your preference over there?
Well, Nigel, you have to stay away. I think their valuations are like 3-4 years ahead into the future, and a lot of the positives have already got captured. These are typically low liquidity stocks as well. Little bit of buying coming in from traders and institutions take the stock price higher. We have seen such phenomena in the past where earnings many years down the line have got discounted, and then if you buy at these levels, you don't end up making as much of a profit or return. End of the day, these are physical businesses. They need to deliver the buses. They need to get into expansion mode as well. There are a lot of execution risks as well, and most of the sales are to government enterprises. So it's a tender-based business which can have its ups and downs. And I don't think that the entry barriers to this business also are very high. And some of the larger OEMs also may be looking very seriously at entering this line of business.
All right. Okay, all right. Deepan, stay with us. We'll just come back with more questions for you. But we have to take a quick commercial break here. We'll come back. Anuj will be with us with what he's making of the market. We'll get you the top F&O technical trades, etc. as well post that. And of course, Deepan is with us, so we're back just a bit. Okay, welcome back. Let's now turn our attention back to the market at an index level and what the broader markets perhaps may do. Anuj is standing by with a quick sense of how he's looking at things. Anuj, morning.
Morning, Prashant. You know what? Again, one of those days where I have a, premonition of a big rally, maybe 150 point rally on the Nifty today. It's possible the market's done that last week once, and it's possible that you have that today, today's weekly options expiry as well. It's very crucial 2 days for the markets. You have the earnings season officially kicking off today with Infosys and Wipro. There's a US inflation data which comes out today, and in that sense, the HCL Tech and Wipro's numbers also tomorrow. So a lot of action would be around the IT companies. As I said, there's weekly options expiry. Nasdaq rallied yesterday. The US 10-year bond yield briefly slipped below the 4 mark once again, though it's now back above that. So I think all of this perhaps could be helping. And the other reason is, if you look at the trade setup, there's been a lot of selling from the FIIs in index futures, 640 crores in index futures and 1100 crores in stock futures. And within index futures, 229 crores in Nifty futures and 410 crores in Bank Nifty futures. And normally the next day you see a bit of a short covering. So that's also another reason that I believe that there could be 150 point rally today. On the Nifty, the first support is 21,500 to 21,525 and the biggest support is 21,448, yesterday's low. But the verdict of the last 2 days is that the Nifty is not willing to break 21,500 on a closing basis, and it's strong as long as it's holding that on close. So let's see. The Bank Nifty is still not out of the woods, but on Bank Nifty, now that the pressure of Fin Nifty's expiry and Bank Nifty's own expiry is out of the way, perhaps that could be the index to track intraday today. The first resistance is 47,450 to 47,500, the 20-day EMA zone. And if it starts to trade above that, my sense is it could even target 47,800 to 48,000. Again, it's a market which is day traders' paradise, not perhaps for positional traders, but both-sided moves could continue for some time.
Anuj, I'll tell you what, if today also we get that 150 point rally, I'll start calling you the Oracle of Worli maybe, because I remember last week out of nowhere we had no cues and Anuj said that my gut is saying that we'll get a 150 point bounce, and well, that's how it played out. So let's see if this happens this time as well. Thank you very much for joining in with the setup today. Let's move on and get you more snippets from Vibrant Gujarat. In an exclusive conversation yesterday at that big summit, Kulin Lalbhai, Executive Director of Arvind, told CNBC-TV18 that the company has signed MOUs worth 3,000 crore rupees across its group businesses, looking to make investments in textiles, engineering and real estate. Listen in.
We signed MOUs worth 3,000 crores across all our group businesses. So we will be investing in textiles, in engineering and real estate. These are the areas where we invest always in Gujarat, and we are continuing to make strong investments across these businesses. As the world looks at diversifying from China, this is the time for India to step up. India has 5% of the global textile and apparel trade, and if we kind of take it from 5 to 10%, we're talking about adding almost $50 billion of export. So I think that is a very big and exciting opportunity, and the world is looking to South Asia to step up.
Okay, that was some of the highlights coming in from Vibrant Gujarat. We have Deepan Mehta of Lexer Equities, of course, still with us. Deepan, hi, morning. So, in terms of stocks in focus, stocks in action, Parikshit was just telling us about some more positive news on the e-bus side, on electric vehicles, essentially. I mean, that's one aspect to perhaps look at. Then there's IT, which are the earnings that have come in, that we're expecting today. On IT, how would you look at an Infosys and TCS, given that stocks have rallied despite expectations of a very, very flat to maybe sort of a, down quarter?
Yeah, so I think that in terms of numbers, we shouldn't expect anything material or great coming out from the IT companies. It would be a stagnant quarter. You could expect some negative, numbers as well below street expectation. But the key thing is management commentary and especially what their clients are saying, because this will be the first earnings season after some of the uncertainty around inflation, interest rates are settled. and all the pundits are convinced that there's a soft landing in the US economy. So whether the confidence is coming back in the Fortune 500 companies to start increasing their tech spends, I think that's the key question to ask. And if there's positive, kind of outcome, positive, words coming in from the management, then I think the IT rally can gather even further pace. Typically, these stocks will discount the future, and valuation-wise, they are reasonable. FI flows also are coming in on the positive side, so they target these large cap companies. So I'm just waiting for what the management has to say, and if it is positive, then I feel this rally can continue. And even in a falling market, I think IT stocks can be an outperforming segment.
Okay, all right. Dipan, I know your view on the old economy stocks, steel as well as cement. But Kalyani Steel, that's not a typical steel company because they deal with autos. So it's a bit of an auto play out there. And they're more or less, pass-through. So they convert steel and, and deal with the automakers. After many, many years, Dipan, I've heard that they've gone ahead and they've officially announced 450 crore acquisition. The biggest problem for the stock was there's no desire to use that cash, and the street was very upset. Now, finally, they've done that. How would you approach the stock at around this 520 rupees odd?
To be honest, Kalyani Steel has just fallen off the cracks and don't really track it per se, but it was a great company and it's a good track record. Specialty steel company, some amount of, I would say, very good location advantages, and of course the Kalyani management. And if they're doing an acquisition after so long, I'm sure it's going to be highly, highly value accretive because it's a very conservative management and they do not get carried away, do not take on too much of debt. And I'm sure they have a very strategic plan to grow that business. So I think that this acquisition will be very positive for shareholders of Kalyani Steel. And, the stock, of course, has done well over the past several years or so, and the momentum should continue going forward.
Okay, all right. Dipan, we will leave it on that note for this morning. Thanks very much for joining in. You have a good day, and we look forward to connecting again soon. Let's take it to our technical experts then. Look at the trading setup and the kind of bets you could perhaps consider today. We have Mitesh Thakkar as well as Sudarshan Sukhani joining in for exactly that. Gentlemen, good morning to both of you. Mitesh, let me come to you first. Very, very choppy day, all kinds of wild moves, but net protecting the downside. That's been the story so far on the Nifty. What's the outlook on the index today, Nifty and Bank Nifty?
Morning, Surbi. My outlook still remains that we are in a consolidation with, as you rightly said, the downside level of 21,500, 480 was protected. We did get a good bounce from there, and I think the idea is that now we should try and test the upper end of the range. The first pivot is around 21,750. And then the upper end of the range is around 21,820. So I think we might see, the markets in a day or two head towards 21,750, 800 zones where I would want to lighten up and take profits in long positions. Only once we get an hourly closing about 21,850 would I want to venture into fresh longs. Otherwise, the idea remains that try to buy near the lower end of the range and sell and book profits around the 21,750, 800, which is the upper end of the range.
Sudarshan, what about you? Good morning.
Good morning. Well, yesterday I had explained that there was a chance that the Nifty could actually find support and rally. There was an intraday rally of 145 points yesterday. That worked. That rally should continue today. So today, after many days, we have this buy on dips opportunity. Trade only on the long side of the market and see if you can make some points. Generally, for the month, my view remains that we are in very choppy conditions, but specifically for today, it's a buy.
Okay, all right. Sudarshan, and good to hear that call yesterday where you said, you could look to get in at lower levels. That worked pretty well. Sudarshan, what about individual stocks? What are you looking at?
Well, BHL is a buying opportunity. Buy with a stop under 196. Exide is a buy. Again, small consolidation, imminent breakout. Buy with a stop under 323. Rampur Cements is making a large, huge distribution pattern. That's pretty bearish. Intraday short with a stop above 990. And Havells is finding support. The chart is not very clean, but for whatever it is worth, there is a buying opportunity with a stop under 1375.
Okay, all right. So those are some of the stocks that Sudarshan's looking at. Mitesh, what about you? Individual stock names?
So we give it too much. I think there's a power failure. I have to come back to you again.
Okay, no worries, no worries. So Darshan, let me just come back to you and get some level checks going for Polycab. The stock is in a lot of news flow. So just want to know the ranges that you'll work with and just your overall sense on Polycab.
Yeah, but I don't track Polycab, so I'm so sorry.
Okay.
I won't be able to give you any ranges.
No worries.
Sudarshan, you did you have Reliance in your as part of your trades? I mean, stock was up 3% yesterday. Any thoughts on that one?
Yes, I think everyone tracks Reliance. See, Reliance is likely to outperform the Nifty, and that means that if there is a buying opportunity anytime in Reliance, we should be looking to accumulate as an investor and also buy as a swing trader.
Okay, all right. Mitesh is, I think, the power back on. Mitesh, your specific trades?
So Prashant, Reliance is in my list. Buy with the stop at 2609 for a target of 2725. I think I had the call yesterday as well. And it's a recommendation to our client, so disclaimer, there is vested interest. That about Crompton is a buy with a stop at 316, targets of 335. LTTS is also on the buying list. Keep a stop below 5280, look for targets of 5465. And Cipla is buy as well. And Cipla, again, has been a stock which I've recommended regularly in the last few days. Now can be bought with a fresh stop at 1309 for a target of 1375.
Okay. What about Polycab, Mitesh? Just pure levels?
See, I think very clearly the stock has had a big breakdown with the kind of news flow and now is showing signs of a deeper correction. I think 4,600 is where we had the stock go through a consolidation way back in August. So that low could be tested. If that gets taken out, then I think we'll look at 200, 40 to 50 zone. But for the timing, I'll keep my target at around 4,600 on the downside.
Okay, all right. We'll leave it there for now, gentlemen. Thank you very much for your time. Appreciate it here on CNBC TV18. Mitesh and Sudarshan. We'll take a quick commercial break here. We'll come back with the pre-open. Apurva Prasad of HDFC Securities will be joining in to help us with IT sector ahead of earnings. Infosys and TCS today and more tomorrow and beyond that. Stay tuned.
Welcome back. Here with us on Bazaar Open Exchange, and we're coming to you live from the CNBC TV18 Motilal Oswal studios. Chandan Taparia is joining in to give us a sense on the F&O market and some trading bets that perhaps you could look at. Chandan, good morning. So what do you have your eye on today?
Good morning, Sulbhi. Thanks for having me. So we have seen some sort of consolidation in the market. The good part is we are in a range, but volatility is clearly visible, and we believe that some sort of volatile swings will be there in broader range. But the good part is the declines are being bought and major trend remains intact. So looking at the Nifty structure, we are moving in a range from last 7-8 days where multiple supports are visible in between 21,400 to 21,500. But at the same time, hurdles are placed at 21,850 zone. So I believe that 21,400 to 21,850 is going to be the broader range. And today, if it manages to hold 21,580, then I think this rally can extend to 21,750 zone. So we'll go with positive to range bound or bias, or positive bias with in range and volatile swings in between. So that you need to take care. And we have weekly expiry and we are holding near its volume weighted average, which clearly indicates that dips could be bought, but upside is likely to be kept in the market. Talking about Bank Nifty index, yesterday it opened lower, but formed a bullish candle. Today, if it opens positive, then it may negate the lower lows of last 3-4 trading session. So immediate support is, if respected, then it can bounce towards 47,777 to 48,000. Now looking at the stock specific, we have selected the counter from IT and auto, while in non-F&O space, positive in the travel and tourism. So talking about first aid, there is buy on BSoft, one of the strongest counter in IT segment, and stock is back on track after the decline of last 2 weeks. Major trend is positive and declines are being bought. It is given a consolidation breakout, forming the higher lows from last 5 trading sessions. So recommending to buy with support of 727. And here we have a target towards 717 BSO. Second trading area, there is buy on Motherson Samvardhan, one of the strongest counter in auto ancillaries. Technically, it has given a breakout from its cup and handle pattern on monthly chart, which has bullish implication. And according to pattern, 10 to 15% swings cannot be ruled out on immediate basis. Higher base is clearly visible. Earlier 100 used to act as a hurdle. Now that is shifting as a higher base. So with support of 106, one can buy Motherson Samvardhan with target of around 115 level. Last trading area, there is buy on Tata Motors. Again, pole and flag pattern is clearly visible, which has bullish implication. We have seen put writing at 800 strike. Supports are gradually shifting higher. Consolidation breakout clearly indicates an upside move towards 840. So one can buy with support of 795 in Tata Motors.
Okay, Chandan, thank you very much for that. So those are individual trades and the FNO setup as he sees it. By the way, the pre-open, if it is to be believed, it's a massive start, but I think it'll moderate as we get closer into sort of more into the pre-open and closer to actual market opening. Just maybe a quick look at the first rates on Polycab, because there is so much interest around that name and what that is doing. Right at the word go. There you go. Polycab coming up with a 10% downtick as was expected. So 44.20 or so and decent sized volumes as well coming through right now. So more on this one, more on the story with our team in just a bit from now. But the other big story, of course, is going to be IT earnings with TCS and Infosys, which will report later post-market hours. Rima is here with key expectations. Rima.
So TCS is the bellwether for the technology industry. When it comes to numbers this time, it's expected to be a weak quarter. Flat revenue growth on a constant currency basis. In fact, the street is quite divided. The constant currency range ranges from -1% to +0.7%. What will weigh on the top line? Weaker discretionary demand, higher furloughs, but there will be a positive impact of the large BSNL deal. Margins are likely to be flat. The absolute bottom line could be impacted by a $125 million provision that the company is going to make for the Epic case. Now, TCS, as I said, is the bellwether, doesn't give you an annual guidance, so qualitative commentary. The body language is more important. Are there any signs of a recovery? Is the macro picking up? What are the CY24 budgets looking like? And even this large $1 billion BSNL deal, analysts fear it's coming in on lower margins. So will it impact the overall margins? Also, the large deal wins announced by the company have been on the lighter side, fewer this quarter. The stock has done about 3-4% in the last 3 months since its last quarter numbers and is trading at 27 times forward multiple.
Well, then you can catch the TCS CEO addressing the media after the company's third quarter numbers at 5:30 p.m. only on CNBC-TV18. Well, Rima, coming back to you then, tell us about the Infosys. They as well report their numbers later today. What do we expect out there?
It's likely to be a weak quarter for Infosys, a dollar revenue decline of 1.8% quarter on quarter, constant currency revenue decline of 1.6%, higher furloughs, weak macros are all likely to hurt Infosys growth. Margins for Infi could come down sequentially because of wage hike, which is effective 1st of November. Now, the company could cut its FY24 guidance. The current guidance is 1 to 2.5%, but many analysts are saying that the company could now say the top end of the guidance from 2.5% comes down to 2%. So 1 to 2% would be the new guidance, and this would be the third guidance cut by the company. Margin guidance is likely to be maintained. In terms of commentary, 1, the reason for the senior management attrition, and 2, the reason for the cancellation of a large $1.5 billion MOU with a global client.
And of course, we'll get you all that action. The TCS MD and CEO Salil Parekh addressing the media after the company's third quarter print is out. The action starts 4:30 p.m. onwards today, and you'll catch it right here on CNBC TV 18. Let's get some perspective on these big IT boys and what lies ahead and the market's expectations. Apurva Prasad, research analyst, IT sector at HDFC Securities, is joining in. Apurva, morning. Thanks for being with us. By the way, Happy New Year to you. First time that we're speaking in the new year. Now, the thing is that, as Rima has been telling us, and most of the notes are pointing out, it's going to be lackluster, flat growth, or maybe some compression for most of the IT companies. But stocks have rallied. I was looking at the Nifty IT. I mean, in the November-December period, the Nifty IT itself is up 15-16%. A stock like TCS hit a low of, I think, 33.50 after the October numbers, and look where it is today. So the question is, have we set ourselves up for a bit of disappointment if the companies don't say that, hey, the worst is over?
Good morning and Happy New Year to you and to the team and all the viewers. So yes, it's been fairly sharp rally. If you just look back last 2 months, it's accounted for nearly 75% of the rally of the entire year. So about 17% up in the last. large part of it, in fact, all of it is largely multiples that have got re-rated higher. So on a 6-monthly basis, we've seen valuations go up by about 20% or so. They're about 2 standard deviation positive currently, so which does mean that margin of safety is not high, is low rather at an aggregate basis. But we do see some dispersion, some of the ones which could be outperforming. But yeah, I mean there could be some disappointment. We do expect Infosys to cut its guidance as well as HCL Tech to also be cutting its guidance for FY24.
And you'd expect, is there any chance? I mean, so if you remember the second quarter earnings commentary, I mean, the interviews and the calls, etc. I mean, take TCS as an example. I mean, they were pretty clear that it's very uncertain. If you remember, the TCS management had said that, they're looking at things and evaluating things every 15 days. That is the time horizon. Is there any chance that things could have turned for the better, and to what degree, if at all, in your opinion?
Yeah, I think a slowdown is a baseline scenario currently. So yeah, you are looking at a lot of those indicators which don't seem to be improving a great deal. So if you look at most of the supply side, tech job postings, markers, I think those aren't yet indicating any major recovery. So I think the commentary, at least near term, is unlikely to be very different from how management has been talking in the past. I think what's going to be interesting is any commentary around the line budgets for CY24 and what's happening on some of those deals, because those deal cycles have gotten elongated. Origination to that getting translated into revenue. I think commentary around some of these areas.
Okay. Hi, Apurva. Good morning. Good to see you in. Apurva, between the two, what's the preference?
So TCS, in my opinion, has got a slightly higher side potential near term. Even from the quarter point of view, there should be outperformance of growth. So CS will be above sea level positive growth that we expect. So yeah, you'll see that growth divergence. It's unlikely that in the near term Infosys.
So the preference is TCS, is it?
I think we're losing Apurva there on that line. I'll try my luck on one more question. So Apurva, between TCS and Infosys, you're saying TCS. Overall, if we talk about the large cap space, which stock perhaps has the potential to show maximum delta? I mean, Rima was telling us, for instance, in terms of pure numbers, HCL Tech could have the smartest top line growth this time around, because I think they have a couple of deal ramp ups that happened. But from a playing the stock perspective, where do you see the best expectation?
Yes, so I mean, for the quarter, we do expect HCL Tech to be at the top end. So while Tech Mahindra, Wipro, and Infosys decline sequential basis, HCL Tech should be closer to 3.5% to 4%. From a opportunity, I would say LTI Mindtree would probably prospects look the strongest. Expect the company to improve from 6-7% growth rate this year to low teens, and with margin expansion, we're looking at a high teens earnings CAGR on a large cap tier 1 IT companies. Potential looks most promising. Yeah.
Okay, all right. We'll leave it there then, Apurva. Good speaking with you. Appreciate you joining in and running us through the expectations from the IT services sector and what you like. I think it's time now for the 9-10 calls. Mitesh is back with us. Mitesh, the pre-open with us, your trades?
Prashant, I'll go with a buy on Reliance. I think, very clearly a big breakout has taken place and it should see good follow through for the next few days. So buy this one with a stop at about 2609 for a first target of 27.25.
CS, we were just having that IT discussion, Mitesh. Anything sort of jump out at you on the charts? Not just TCS, but anything in IT.
Yeah, I have a call on LTTS, but that I think I also like HCL Tech a lot. I think, that was a call earlier, a couple of days back. I think many of the IT stocks are in uptrend, but these two looks like to be the most outperforming stocks.
By the way, in the pre-open, some of these large cap PSU stocks are looking like they could start positive. Coal India, ONGC, Even SBI for that matter, quite a of them are on the upside. They all had profit taking yesterday. Any PSU trades, Mitesh?
SBI. I think, if I was to choose one, SBI, I think, has come down to a good support level after the last few days of decline. There's a trend line support as well as a earlier high, which is a pivot around the 615, 620 levels. So around these levels, buy with a stop below 610, and I think the highs of 650 should be visited and maybe even crossed on the upside.
Okay, all right, Mitesh, thanks a lot for that. We'll keep coming back to you, all through the show. Well, let's focus on the top stock in pre-open itself. Polycab is down close to around 10%. Timsy joins us to give us that update with regard to the IT findings. Timsy?
Well, yes, the Income Tax Department yesterday in a press release mentioned that they recently in December, to be precise on 22nd December, they conducted search operations against a company which is the manufacturers of wires and cables. They did not mention the name, and sources said that this press release is regarding the search operations against Polycab. Now, what are the evidences and findings that the investigation during the search operations actually hinted at? Remember, the operations were conducted at 50 plus premises, and they were spread across Mumbai, Delhi, Gujarat, etc. And they say that 1,000 crore rupees of unaccounted cash transactions have been identified. Also under identification during the investigation are 400 crore rupees worth of, transactions which were, these are the cash transactions to be precise again. And yes, for the non-genuine expenses in the nature of subcontracting expenses, purchases, and transport expenses, etc., aggregating about 100 crore rupees have been identified. So let's see what is the final cash outgo or the tax outgo, to be precise, that the company will have to make when the final demand has been raised against the company.
Absolutely, Timsy, because from that release yesterday it became very clear this is not just about, some tax not having been paid. The allegations that are very, very serious in the PIB statement. We have Polycab, by the way, down 10% straight away in pre-open. Hormuz has been looking at some trading stats around this counter as well. Hormuz.
It's not been the best start to the year for Polycab. It's down 10% in pre-open, and it was down another 10% before today's session as well. But despite the lackluster start that it has had to the year, the street still continues to remain bullish on the stock. Almost 60% of the 31 analysts that track the stock continue to have a buy rating on the stock. And the number of sell recommendations now are down to a 3-month low. They've been declining consistently since October. And the highest price target right now on Polycab is from Jefferies, which is a 7,000 rupee target, implying a 42% potential upside. And Polycab has been a 10-bagger since it listed at an IPO price of 538 rupees, listed in April of 2019, and it made a record high of 57.33 in December of last year. And since it listed, it has delivered positive annual returns every single year, barring this year, of course, at the start of the year. And when it comes to shareholding, the promoters have been gradually reducing their stake over the last 6 quarters. But the interesting bit is that the shareholding of domestic mutual funds, as of September, we don't have the December shareholding yet, but as of September, it's down to a 3-year low. And for foreign investors, they have been consistently increasing their stake from around 6.5% to around 12.5%. And over the last 5 days, the delivery stats have ranged anywhere between 30 to 40%, with delivery buying seen anywhere between 80 crores to around 650 crore rupees. Back to you.
Okay, all right, Hormuz, thank you very much for that. Let's see how it plays out in the actual market. When the rates kick in, and that will happen any minute now. The indication is we start about 70 points higher. Asia has been very, very positive. US markets rallied. Question is, can we build on to it really and now test the upper end of the trading range? There goes the bell. And we start with a 74-point up move. ONGC is right on top of the heap. You have some auto stocks that are starting strong. There's Hero Moto up about 1%. There's some buying on M&M as well. Adani Enterprises starts out with a 1% up move. State Bank of India, Bank Nifty is strong, by the way, 0.5% up on the Bank Nifty as well. SBI is leading that banking charge. Axis Bank is looking smart as well. And to start off with, the LTI Mindtree is positive. I'm just looking at Infosys, flat for the time being. And TCS is seeing a mild gain of about 0.5% as well. So the large cap screen is looking good. You've got some more names like Tech Mahindra now on the tech side. Wipro is looking positive. Reliance continues its big move from yesterday. So the good news of the market is you've got banks, IT and Reliance all contributing, and that explains the strong start. On the downside, there's not much actually. Only Dr. Reddy's, which is down about 1.5%. Infosys, HCL Tech are absolutely flat. Otherwise, bulk of your Nifty stocks, almost 48 out of 50, are opening out on the green side. So, good start to the day.
Well, good start of the day. Stock of the morning, Polycab. Stock is now down closer around 10% and, it's at lower free. So, that will get flexed in the next few minutes or so. So, that's the one that's in trouble. On the flip side, in terms of the F&O stocks, the biggest gainer is Shriram Finance. So, that's up closer around 5% as we speak. Flying away. NCC, you had a large fund coming in there yesterday and buying a stake in there. That stock, in fact, is up closer around 3%. Massive volumes. Torrent Pharma is another top gainer, up closer around 3%. And Coforge as well, up closer around 2%. So that's about all the big stocks that are moving around. Gale, there was another downgrade that came in earlier today. So that stock's lost closer around 1.5% in terms of its market cap this morning. Stocks moving up. Well, the smaller jewelers, they continue to move with excitement. Hopefully, the fundamentals as well are in line. RBC Jewelers, you have Motisan Jewelers, both of them up between 8 to around 10%. So those are doing pretty well. Palmer Lorry as well as up close to around 5%. One of the top volume traded stocks in early morning trade. So that's another big mover today. Easy Trip is another stock that's up close to around 3%. And RVNL up close to around 3%. Remember, yesterday towards the end of trade, you had IRCON that moved up and a couple of these railway-related stocks. Today, you have RVNL that's moved up. And Abhishek told us the Bank of India numbers weren't so bad, the operational performance. Well, that's one of the top banking gainers today. It's a good start. First few minutes look good. Nifty moving towards 21,700. The Nifty Bank clawing its way back to around that 20 DMA. 200 points away. That's going to be the big trigger for me.
I think, it's a good start, right? 80 points. Just a few other names. You were talking about smaller jewelers, but Senco is the big mover, right? 10-11% on Senco. Third quarter update coming through, and it's got humongous volumes as well. So on the downside, Polycab, of course, is down 10, but look at KEI as well. I mean, maybe collateral damage, but KEI is down 6%. It's big volumes, so it's not... It's coming off on very sharp volumes, 29.30 or so on KEI. Not sure there's any individual stock price performance or this is rub off from what we're seeing at Polycab. But now almost 7% gone on KEI Industries. Okay, Cochin Shipyard is down about 2%. Stocks at about, 786. It's the top volume traded loser across the board in the market. Dr. Reddy's is down about 1.8%. There is AstraZeneca, which is coming through and is down about 3% or so. Large volumes. Delivery is down about 1.33% as well. Look at RR Kabel. RR Kabel also had some, ED issue, the tax issues, alleged tax issues, but 3% lower on RR Kabel as well. So 15, 16, 15, 17. All these companies where, especially on the building material side, wires and cable, where there is significant B2B exposure, that is where the cuts are actually coming through. Let me just run through some of the stocks on the upside as well. Railway is a big theme. IRFC, RVNL, both up 5% and 3.5% respectively. So a big, large volumes as well. Olectra, the bus maker, we just, of course, had that news flow from Parikshit. 4% on Olectra, 1776 is where we are at. And I think we did mention Shriram Finance, which is gaining with about a 4% sort of gain at this point in time.
Just to tell our viewers why Polycab is down, the news that's coming there, it's negative. It suddenly raises corporate governance issues which weren't heard about earlier. The stock is currently trading at around 30 times, around 28, 30 times. After assuming the EPS moves from around 85 rupees to around 160 rupees. So that's, valuations weren't in their favor. The earnings growth as well you're looking at was very, very steep. The institutional holding in the company is around 20%. And this sort of, news flow worries institutions in particular. And the other point that we were asking Deepan as well about is that will it paint the sector as well? Because we're talking about the largest company in here, B2B exposure. So that's why I think it has a bit of a rub-off impact. Earlier, we had RR Kabel that we heard, and now you have Polycab. So that's why it appears the sector itself is seeing a bit of a knockdown.
By the way, Havells, not to say that it's in the same space, but there's some buying on Havells that's evident for the time being. But otherwise, Polycab, I think the bigger issue is that this is not just, some tax mismatch. Going by that press release, the allegations are far more serious in nature.
So we'll have to hear from the management and we'll have to wait for the numbers as well, because now, they'll have to deliver a fairly good set of numbers to keep the street interest in there. I think next week or so is when we get their numbers.
No, guys, I think the numbers have been, as you said, They've been actually too
Very
good,
good. Yeah.
right? So there's no problem with the numbers as such. So this is more corporate governance and those kind of things. But I think, it'll be interesting, and we'll try and do that. Look at all instances where there were these kind of, allegations of evasion, etc. What happened to stock prices immediately after the news broke, and what happened, say, a week later, a month later, where stocks were. We'll try and do that. For now, of course, as expected, stocks down about 10% or so right now. The market's up about 90 points, and things are looking pretty good overall at the index level. Sunil Kaul is with us. He's equity strategist, Asia Pacific at Goldman Sachs. Sunil, great to have you with us here. Good morning. Thanks very much for your time. Great 2023, actually great last 2 months of 2023 as well. And the start to 24 has not been bad. It's not been a great flying start, but January seasonality perhaps at play. What's your overall sense, though? Should one head into this year with slightly lower expectations, or we could have a repeat performance?
Yeah, Prashant. I mean, first of all, Happy New Year to you and the team there. I would say, look, I think the markets have started the year a little bit soft, as you said. But that's probably sort of the region across the trend across the region, right? I think what's happened in the last couple of months is that the macro environment, as we all know, has shifted a lot, right? So we have better US growth, easier start to the Fed rate cuts, possibly easier start to the Asian central bank cuts, dollar backing off, and so I think the markets have kind of priced all of that a little bit too quickly. And that seems to be kind of partly in the price. And so what we are seeing in the first trading week, at least of the year, is some of that is getting a bit unwound. But I think our overall sense for the market for the full year for India is that we remain structurally positive on the market. I think one of the things I wanted to mention is that if you look and if you talk to people generally say that Indian equities have done very well last year, 20% returns for the market. But I think what's less known is that if you look at the 20% return for the market, it was all earnings led. So 18% out of that 20% was actually earnings accrual. And so we did not actually see much change in the multiples for the market. So it's a good fundamental rally for the market. Overall, we think this year we could see Nifty hitting 23,500, which is about 9% upside from current levels. But I think the maths for us is that we think earnings will grow about 15%. And even with multiple derating or compression in our numbers, we think you can still sort of see decent upside for the market overall.
Hi, Sunil. Welcome to the show. Nigel on this side. That's an important point you make, right? Everyone looks at the PE and says that the Nifty went up 20%, but the earnings as well kept pace. So the PE was more or less intact, which is pretty good news. Sunil, the last time we chatted, you were telling us that, you have increased allocation to India. At current reckoning, what have you all done of late? Have you all added, or, it remains one of the top markets that you like, but what's the view from here on?
Yeah, Nigel, we are overweight the market, so we stay overweight India. So we have other parts of the other markets in the region where we are overweight in, notably sort of Korea, Japan, and China. But India also is there in our pecking order, right at the top, with one of the strong overweights there. I think the difference is India for us is a structurally overweight market, but I think for some of the other markets, some of them are much more deeper cyclical and are coming in from much lows. So there's a cyclical pickup in those markets. But as I said, based on our return expectations, we do think India should be a market that will continue to perform well this year.
Okay, Sunil, hi, morning. Good to have you on the show. So since your overall, sense in the market is still optimistic, in terms of the construct of the portfolio, to what extent would you go with the themes of 2023? I mean, industrials, capex, PSU stocks, defense. These were the big sort of trades or the big investment themes of the previous year. Are they still good for more?
Surabhi, that's a great question. Look, I think in terms of the portfolio construction or in terms of themes, we do think there will be some things that will shift, right? So if you look at it from a sort of styles lens or a thematic lens or a factor lens, as we all know, I think the big trade for last year was sort of a rally in small and mid caps, and large caps were sort of laggards, right? So one of the strong views we have for this year is that we do think large caps outperform small caps. And so one of the sort of the ideas therefore we have is kind of look for companies that are large cap, that have good fundamentals, but that have lagged the broader market. So I think that's one pocket, and I'll come to the sectors in a bit. But the other shift we are expecting is that of quality. So if you look at the quality styles, for example, strong ROE companies, strong balance sheet companies, those actually have been laggards in the last couple of years. It's value that has done better. So we also think this year it will be sort of quality companies coming back. Obviously, you have to think a bit about valuations. So for lack of a better word, we're kind of looking at a GARP approach, so quality at a reasonable price. So the companies that are sort of giving you decent earnings and revenue growth, as well as have strong ROEs north of 15%, we like those companies. In terms of sectors, our overweight are banks. So that was a laggard last year, but we think that should perform well this year. So that would be a change. We also like autos. And in addition to that, we have industrials. I mean, that one you can say, obviously, they have done well, but we think on a more medium-term basis, it still makes sense to be in the industrials or broader manufacturing cycles, given the benefits from PLI and the broader shifts in the supply chains across the region. And then we also have overweight on utilities, which is more a call on India trying to kind of grow at the same time kind of trying to decarbonize. So we do think that as we continue to hit some peak power deficits in the economy, you will see some of the legacy sectors, thermal, continuing to re-rate, and at the same time some more improvement on the energy efficiency side, on the renewables. So I think, therefore, banks, industrials, autos, and utilities will be the four pockets where we are most constructive on at this point in time.
No, got that. Sunil, we'll get back to some of these individual sectors, etc., in a bit. But I just wanted to get a slightly broader view from you. I mean, you guys at Goldman Sachs pretty much talk to all the large investors around the world. When we talk about allocations and a market which is poised for takeoff and many years of steady growth, etc., how much of the sort of investable money equity assets are already here, and how much is yet to make their first kind of allocations to India? I mean, I don't know if you've done any work on that.
No, I think
because if you're not here, then irrespective of the price, you'd want to be here, right? You'd want to make
that's
an
a great
allocation.
question. Look, I think the narrative out there generally is that given India has done so well, I mean, as we all know, it's been like 8th straight year of positive performance for Nifty, right? So it's been a great compounder in the region. But I think the narrative out there is like, look, I mean, India is super crowded, it's expensive. But if you sort of talk to people, I think the general feeling among a lot of investors, at least last year, was people kind of missed the broad rally in the markets. Either it was because of high valuations or it was because of the elections. And obviously the rally was more concentrated in mid and small caps. So a lot of the clients we have been speaking to, they have broadly missed the rally and sort of very keen to increase exposure. But when you also look at the data, it's very clear that people are not, the positioning is still overall quite conservative, right? So just to give you a couple of stats. So for example, if you look at emerging market investors, their overweight allocations is around 100 basis points during the peak. Historically, that's been as high as 500, 600 basis points versus the benchmark. So the overweights are much lower than what they were in the history. If you look at the global long-only funds, they are still underweight India. If you look at the aggregate foreign ownership for the Indian equities, they're towards the bottom decile of its last 10-year range. So whether you sort of talk to people anecdotally or whether you look at the hard data, it's quite clear that there is more allocations that could increase, and people from our conversations, as I said, are very keen to increase the allocations. Because as you said, Prashant, if you look around, it still feels like most of the larger economies, you're seeing slowdown in growth. So growth is sort of slowing in US. We have Japan slowing. We have China slowing. We have some of the other larger markets in the region, including Australia, slowing as well. So India still looks a market where macros are very stable, earnings are growing, and you still got decent sort of growth. We are looking for example, 6.2% GDP growth next year and this year. So across the region, it still looks like a structural place to be in, and so we think, therefore, foreign money should continue to come into the market, especially post-elections as well.
Well, Sunil, that'll be music to the ears of all the investors and our viewers as well, that India continues to remain a structural theme and standing out within the pack. But what about the central bank? You know, everyone's debating on what the Fed is going to do. What kind of action are y'all anticipating from our central bank? That's the RBI, which has done a very, very good job in the last few years. Are you all factoring in rate cuts from the RBI, or are you all not in that camp?
No, we are factoring rate cuts, Nigel. So just to be transparent, so our Fed call as well as India call actually has shifted somewhat in the last couple of months. So we were expecting only, the Fed cuts to start in Q4 of this year. That was before the December policy meeting. But after the dovish tone from FOMC, we are now looking at Fed cuts starting as early as March. So we have actually 5 Fed cuts baked in our forecast for this year. I think the market is somewhere around 6 to 7 cuts. So a little bit dovish than that. But we have rate cuts from Fed. For RBI, we were actually looking for rate cuts to start in Q4, which is kind of in line with higher for longer view before. We have also front-loaded that. So we're now looking for 2 cuts from RBI in Q3 and Q4. So cumulative 50 basis points rate cuts. So the repo rate goes from 6.5 to 6. But I think the one thing to note there would be that we do think that in terms of the sequencing of the easing, you probably start off with sort of easing the liquidity in the banking system. That probably comes more in Q1, Q2. Then probably they shift the stance, which is currently withdrawal of accommodation, to more neutral or accommodative sometime in Q2. And then, as I said, Q3, Q4 is where we're expecting cuts. So overall, sort of easing, but the easing starts through easier banking liquidity and then from the rate cuts.
Okay, got that. So rate cuts will obviously make the market really happy. So Sunil, I'm just going to go back to that point that we were discussing on the portfolio construct side, specifically 2 sectors that you named, industrials and utilities, because here stock prices have rallied quite a bit. As I said, there were themes of 2023. So A, how do you find valuations today vis-a-vis, the long-term averages? Are you still comfortable? And B, what would the next round of sort of kickers be? In terms of execution, for instance, where are you expecting a better pickup? And what is it that could still drive these stocks another 20, 30, 40% higher, given that many of them have been doublers or maybe even trebled in the last 12 months?
Yes, sir. We are aware of the valuations being a little bit expensive. So if you look at the broader manufacturing sort of cohort, sort of include not just industrials, but industrial, cement, real estate, as you said, utilities, the broader sort of investment cyclicals, we have indeed made some changes recently to the overall allocation. So for example, we actually took cement down from overweight to neutral. And so we do like cement longer term. It obviously plays into both the real estate recovery cycle as well as the infrastructure. But the fact, to your point, the fact that sort of in the last couple of months, the stocks went up 15% plus, and the next couple of quarters, probably volumes are going to be much more muted. We do think that the absolute upside on a more tactical basis is not going to be there. So that's why we kind of neutralized it. I think for the industrials overall, even though the infra-related names, the order books could be muted because of the election cycle, I think the broader industrials, the reason we stay overweight that camp is because there are other segments. For example, you have the logistics segments. There is the broader structural theme of kind of unorganized to organized shift, which we are seeing. There is also kind of better execution we are seeing, for example, in the EMS segment because of the PLI. So I think there are sort of micro stories which are definitely benefiting the individual stocks. And so on the bottom up basis, we do think the industrials therefore sort of makes sense. There is obviously transportation, which is airlines also in there. So it's kind of a mixed bag. And some segments we like there, which is the reason for being constructive there. I think the thing you sort of partly sort of alluded to, we do require the private capex cycle to come back, and that is our expectation that post elections we do see some of that improving, and if that improves, that probably could give another leg of sort of rally to some of these stocks. So I think that is a part of our expectation at this point in time. So I think that's something I would point to. I think for utilities, as I said, it's a function of sort of demand supply. We still think, given the demand for power is still very strong, and even though India is trying to decarbonize, it will take some time, which means that in the near term you continue to run into deficits. in which case, for example, some of the thermal related stocks that can continue to see re-rating. They have done well, but I think relative to the broader market, if you look at valuations, they're still sort of inexpensive. So we think there is still further room for some of those areas to re-rate. And then I think we also, as I mentioned, expect more progress to happen on the renewable side, especially given the cost for solar has come down. So we think there is sort of more to run up in those sectors. Because if you sort of rank these sectors relative to other bits of the market, especially some of the consumer discretionary bits, utilities still screen out much cheaper.
Okay, well, that's a very comprehensive sort of rationale for why you're expecting some of these big themes to continue perhaps performing and more micro opportunities within the larger complex as well. Sunil, great talking to you this morning. Thank you very much for joining in, and we look forward to more conversations during the course of the year. Well, with that, let's turn the spotlight on a couple of corporate conversations, and the stock that we're focusing on is Aarti Industries. A pretty important development happened with respect to the opportunities that the company is looking at. Just a couple of days back, the European Union has decided to not renew the approval for S-metolachlor, if I got the pronunciation of this product correctly. Now, why is this important? Because a couple of weeks ago, Aarti had indicated that there could be a big opportunity, as much as perhaps 3,000 crores, where they would supply intermediaries to this, this particular product. Now, how does this really change the scheme of things, if at all, and what is the outlook going ahead? To discuss this, we have Mr. Rajendran V. Gogri, the CMD of Aarti Industries. Mr. Gogri, thank you very much for taking this call. So first, let's straight away get to this, this product where the approval has not, or the renewal approval has not come through. Can you tell us how this changes things? Because in the earlier statement that the company gave, the opportunity you saw for Aarti was as high as perhaps 3,000 crore rupees. So what now?
Yeah, actually, this S-metolachlor permission in EU is cancelled, but EU is not a big market. Only about 6 to 8% of the total global market for S-metolachlor is from EU. And the intermediate what we make also goes in other products. So S-metolachlor is only about 50% of the global market for that intermediate. So overall, for our product, the demand impact will be only about 3-4% on global levels.
Okay, so
is the opportunities, you just basically you shave off about 3-4%, but you're still looking at well over, what should we say, 2,700 crores of the opportunity from this intermediary? And if yes, by when do the numbers start flowing in? When do you start, making these supplies?
Actually, we already supply them in the current financial year also. And that is going to be ramped up in FY25 when our major expansion takes place. And by FY26, we should be at the full ramp up for this product.
All right, Mr. Gogri, hi, good morning. Appreciate you joining in. Earlier when you gave this number of 3,000 crores, let's set it over the next few years. Now you're saying that, the European part that's in question is around 3-4%. So should we shave off 3-4% from that 3,000 crore mark, which would give me a number of around 2,850 to 2,900 crores? That opportunity is intact. Should we assume that?
Yeah, that opportunity definitely is intact, yes.
Okay. So, all right. So instead of 3,000, it will be maybe 100, 150 crores lower. We got that. When you put out this announcement, you said that the deal is with a big global agrochemical company. Just want to clear the air. Is it UPL?
Yeah, that is under confidentiality, so I'm not able to comment on the specific name for that.
Okay, because the street was a little bit confused, because you had mentioned big global company, but UPL is headquartered here in India. So we just wanted that, but you're saying it's confidentiality, so we'll keep that aside.
And just
UPL is also a global company, so
is UPL the one then? So is UPL the one then, sir? Because the street believes so.
That I cannot comment on whether it is UPL, but UPL is also considered a global because they have a global operations.
Okay.
Now that they certainly are, sir. Just to go back to that number, so not 3,000 crores, but you will hopefully get about 2,900 crores. You said a ramp up will happen in FY25. How much of this 2,900 crores will you book in the current year, FY24? And how much perhaps of this total amount would you book in the next year?
So basically, we'll be around 50% in this year, so around 140. and 200 plus in FY25. And by FY26, 300 plus will come.
Okay, all right.
Mr. Gogri, good morning. Prashant here. Just a quick point, sir. The one of the notes, analyst notes, points out that, of course, you're saying that you'll be able to realize this 3,000 crores by FY26, and of course, you've given us the hit, which could be 3-4%. But, there is also some who are pointing out to past long-term these kind of contracts which have been struck. For example, one note says that between 2017 and 2019, you actually unveiled 3 long-term contracts. There were expectations of substantial revenue contribution from each of these, but it has not yet been materialized. The initial contract, for example, they say, saw considerable overrun in capex and was later terminated. You got some compensation for that, but that was about it. So, would you like to assuage some of these analysts in terms of what this, what happened in the previous contracts and whether we will see something completely different with this one? Just your thoughts, sir.
Yeah, the first one, because the customer decided not to expand their plant in Western countries, and so they didn't needed that intermediate. So that was the reason they canceled the contract, and we got almost around 750-800 crore as a compensation for that. But second contract, once it is commissioned, it is running as per the expectation, and only the project delay was mainly because of the COVID. And same way, the third contract also, the project delays were mainly for COVID. But that contract is also commissioned, and we'll be getting the turnover from that contract as per our estimates.
The second and the third contract, sir, by when should we expect material accretion to revenues?
For which contract you're saying?
The ones, the second and the third contracts which were struck between in that time frame that we were talking about. By when should we expect significant accretion to revenues from both those? You said the delay largely has been due to COVID.
Yeah, the second already from FY22 onwards, that is already running. And the third one was commissioned in FY23. And this year is more of a stabilization. So third contract, will have around 50% in FY25. And then, we'll be at a full ramp up for the third contract from FY26.
Okay, all right. Mr. Gogri, final question from my end before we let you go. I think earlier you were working with an EBITDA number for this year, that's FY24, of around 950 to around 1,000 crores. Do you stick by that? You could give us a brief idea on that. But more importantly, for FY25, I think earlier you were talking about close to around 1,400 crores. So by which quarter you see yourself go from that run rate of around 240 to 250 crores per quarter to around that 380, 400 crores per quarter, quarter 1 of next fiscal year or quarter 2?
Yeah, this year our guidance we have given at the Q2 result 950 to 1,000 crores. So that we are maintaining that guidance as of now. There is no issue on that. And for FY25, we had given a guidance, which is about 1,450 to 1,600 crores EBITDA. And FY25. So it will be growing over a period. So second half will be higher than the first half.
So you hit 400 crores per quarter when? 400 crores per quarter by quarter 2 of the fiscal to get to that 1,450 to 1,600 crores EBITDA?
Definitely by quarter 3.
By quarter
so it will
3.
be every quarter next year we'll have a ramp up basically.
Which brings me to my final question as well. Most of the notes, if we look at expectations for the third quarter, most of the broker notes are pointing to a sequential improvement, continued sequential improvement, even margin expansion. Given that you're looking at a better run rate in the second half, can you say that, the bottom has been made? What is the visibility on demand, ramp up of products that you can, tell us about as we get into the new fiscal?
Yeah, discretionary demand, I think virtually is recovering. So we expect FY25 to be near normal for discretionary demand. But agrochemical is molecular specific. So some agrochemical demand I think will get recovered by within the first half of FY25. So by first half FY25, I think more or less all the demand should be on track in next year.
Mr. Gogri, you said that just to come back to the news of EU not deciding to renew the approval for this particular herbicide, is it possible other regulators also follow their suit? Because I mean, the reason why they've not renewed the approval is because of they don't it's about safety issues essentially. So is it wouldn't other regulators take cue from someone like what's happened in Europe?
No, as per the feedback what we are getting from our customers, there are no such ongoing issues on this product in any other geography.
Okay, not yet though, as I guess we can learn. Thank you very much, Mr. Gogri. Appreciate you joining in. It's a pleasure having you with us here on the program. Thanks indeed. So that's Aarti Industries with some perspective on the impact on the business. Pretty confident that maybe some recovery is underway from the first quarter of FY25. Well, the markets come off a little bit, but not by much. 67, 68 odd points higher is what we have, 21,690. We'll take a quick commercial break here. We'll come back. We'll connect with Vikash Kumar Jain, India strategist at CLSA. So what is CLSA's outlook for 2024? Vikash, of course, also tracks companies like Reliance, oil, other oil stocks, all of that coming up in just a bit from now.
Welcome back. Well, the markets continue to hold well in the green, but you're not able to build onto those gains actually today. At least for the time being, we're holding close at around 21,700. The Nifty Bank at around 47,500 odd. But time to get straight to another exclusive market talk. We have Vikash Kumar Jain, the India strategist at CLSA, who joins us on the show. Hi, Vikash. Good to see you in and wishing you, your team, a cracker of a year in terms of 2024. 2023 was very good. So hopefully things look up for equity markets. Well, Vikash, we normally see this pre-election rally. But it seems this time around the markets took the state election result with both hands and they started factoring some part of that in. Do you think most of that pre-election rally is in the price or do we have more to go?
Yeah, so I think November, December was particularly very good. And if you see two big events, market got super excited about. Of course, we had our own state elections where markets started believing that this is perhaps a very accurate reflection of what will happen at the national election. And secondly, US Fed suddenly reducing its hawkish stance or maybe to the market's reading, turning dovish. I think both of those happened in that two-month period. And we started the year with perhaps with that expectation of third term for the current government already largely baked in, plus 160 bips of rate cut expected from Fed as per market expectations when we started the year as compared to 75 bips. Just to digest that, 160 bips basically means rate cuts in 6.5 of the 8 meetings that Fed is supposed to have in this year. So that's the kind of expectations we started the market with. And to kind of maybe quantitatively look at that expectation, the one thing that we have is our proprietary India Bull Bear Index. It started at an extreme bullish level of over 95% bullish. So clearly, very elevated expectations to start the year with.
Got it. Vikash, hi. In your latest strategy note, you're basically saying that you prefer mega caps, banks, insurance, and energy. All right. So that's a broad kind of focus that you have. What makes the cut in terms of stocks within these pockets in the model portfolio? What are the top ideas?
So I think, the top ideas without being stock specific, that if the report is with you, you already had the top ideas. But the broad thought process when we are constructing the focus portfolio, and we also had another report where the title of the note was "Greed is not good." I think that's really the theme with which we are working with for 2024. Like we discussed, the starting point being quite, where a lot of hope already baked into the starting point. In addition to that, if you also bring in the fact that our favored valuation benchmark is also quite extended, it's at a level where historically empirical evidence from that level, if you invest, returns have been very, very, very low over 1 or 2 year periods. So the portfolio construct is with the thought that it is unlikely to, this year is unlikely to see a runaway rally like last year. Of course, I hope that I'm wrong and we have a great rally, but it doesn't look like this year. So from that perspective, I am much more heavy on risk-reward mindset in the portfolio picks that we have. Clearly trying to protect downside, and wherever we see reasonable risk-reward, trying to play that upside. I think the benchmark to beat to outperform will not be very high. So that's really the thought process when selecting those names and sectors that we discussed.
And greed is not good. I'm assuming Vikash is
Gordon
a play.
Gecko, he's not with Mr. Gecko, is he, Vikash?
Not for this year.
Okay.
Maybe next one.
Okay, just for this year. That's an important caveat as well. But Vikash, let's talk about the underperforming parts of the market, relatively underperforming. We were talking about, FMCG and, for instance, even IT, which has been more patchy than anything. Are you expecting any sort of a, shift over here? The problem is that in terms of earnings, the numbers are still not adding up for pure play staple companies. We're talking about this mid-single digit growth. But in terms of investor interest or just tactical portfolio shifts, do you see, any interest coming back in this part of the market?
So of the different calls that we have in the model portfolio, our biggest out of consensus call is that we have zero weight in consumption, zero. So pretty big underweight in consumption. So the way we run it is it's a focused portfolio. We try and keep it high conviction, and we've avoided consumption for a long time, except for over the last 3 years when we've had this portfolio. There have been times when we've been involved with auto names, but in general, staples is something that we've never had in the portfolio in the last 3 years. Having said that, we need to be clear about the kind of companies that we are talking about. These are super high quality companies with a lot of respect. However, the investing environment has changed for them. That's because one concept which was largely forgotten in the last decade is back. Cost of capital is important in this environment. Yes, Fed rates are going to get cut, but we're not seeing anywhere close to zero rate is not what we are expecting. However, valuations for these companies, because they generally do not crash. These stock prices rarely crash. They at best will derate very gradually. I think we are in the midst of that derating process. There's still some of these stocks are available at, are still at 2.5-3% earnings yield at a time when US bond yields are over 4%. So the environment, the investing environment has changed. Cost of capital is a concept which is back. They're in a gradual derating process. There will be time tactically here and there when people think of these as good hiding places. But, the other thing which has changed is that we now see they're far more confident of earnings growth in Nifty, talking of 14-15% kind of CAGR numbers. That's very different from where we started in the period of last decade when banks and many of these others were suffering from the excesses of the decade before. And earnings growth in Nifty was much lesser. And then 10-12% of what these companies were offering at a much lower valuation was something which was looking super exciting. That both of those things have changed. Valuations need to kind of correct to more palatable levels. Sure. And earnings growth, is already higher for the rest of the market.
No, Vikash, so let me come to the other, pole extreme of consumption, and that's discretionary. And look at what's happening, for instance, to these small jewelry stocks, right? I mean, the smallest of them. Yesterday, I saw the market cap was 700 crores, and today it's 800 crores, just because the market's bidding up anything and everything on the discretionary side. Yes, the property players are showing fantastic sales numbers, but again, there I go back to, the theme of your note. Greed is not good. So, I mean, how do you place your bets on the discretionary side then? What would you still buy and what would you avoid there?
So, the way to think about it is as market becomes extended, typically narratives shift away from 1 or 2 years. You start talking of trying to play the 3-year, 5-year story, although the fact is that the reverse should happen, but that's rarely the case. And some of these stories are very exciting when you want to say jewelry. You know, the listed jewelry space is typically organized taking share from unorganized, in general over the next 4 to 5 years, disposable incomes rising for Indians. So it does fit pretty well. I'm just saying that there will perhaps, because we start with such expectations and most hopes baked in, there will be periods when there will be correction to those expectations, and then many of these elevated valuation areas will get corrected. But till that happens, clearly we'll play the 4-year, 5-year story, and where, you know, a lot of these discretionary in general, rising disposable income in India fits pretty well as a theme. So I think that's what is happening. I believe that sometime in the first half, we will have jitters, which will perhaps correct our expectation and normalize it. Like, for example, when Fed speaks on 31st January, perhaps the Fed governor would realize that he had pushed the market a bit too ahead. And I would not be surprised to see him trying to bring back expectations to more normal level. As compared to the dot plot of 3 cuts, market bakes in 6 to 7 cuts. I think some of that needs to correct and normalize. I think that will be the opportunity for us to kind of get back into the market, maybe start thinking more on risk. Right now, we need to try and protect our downside.
Got that. Vikash, very well put. Briefly, is this budget going to be meaningful? It's a vote on account?
See, I think I'm not too hopeful because, you know, what needs to be done, and a lot of people are talking about consumption. I don't really sense the government changing its supply side policy making approach. They believe that they have got a lot of success from it. Our discussions with many people, you know, who are closer to policy making gives us that sense. So I don't see that changing per se. So I really doubt there'll be too many surprises. Anyway, it's more of a vote of account. I'm not too hopeful on any sector specific, big changes right now. We'll have to wait for the next one, which is after elections.
All right, Vikash, we'll leave it there. Thank you very much. Good conversation as always with you, and hope to have you back soon again. Thanks indeed for taking out the time and being here. Well, it's time for our special segment, Quarter Se Quarter Tak, where we get you earnings expectations from a different sector every day. Nigel is standing by with what the expectations are from the cement space this time around. Nigel, over to you.
Well, for the cement companies, there are 3 big factors at play. First, cement prices, decline in costs, and also results will come on a low base on a year-on-year basis. Cement prices were increased in North, South as well as West India at the start of the quarter, while in East India they were increased in September 2023. Now, some of these increases actually did pull back a little bit from November due to the reduction in demand on account of festivals as well as labour shortage. The benefits, though, of the fall in energy prices will reflect in Q3, and that's what will help in result in lower cost, and that's what will help the EBITDA getting a bit of a leg up, because the cost will come in at its lowest levels in the past 7 quarters. Jefferies estimates that companies in their universe to post a 50% year-on-year growth in EBITDA, and the EBITDA per ton will increase to 4 digits, that's more than 1,000 rupees, after a gap of 8 quarters. On a regional basis, well, the North-based companies are likely to outperform. That's going to be driven by higher year-on-year growth, both in volumes as well as in prices. Now, after growing in double digits for the first 2 quarters of the year, expectations are now that the cement industry demand will slow down to mid-single digits in Q3 FY24. The state elections, the festival season and bad weather in South India, that's what impacted the construction activity during the past quarter. Ultratech as well reported a 5% growth in India volumes in Q3, and that's likely to be in line with the industry growth, unlike what we saw in the previous few quarters when they led in industry growth, and in fact, they outperformed in the previous quarters as well. Jefferies, they expect ACC as well as Ambuja to have higher growth in EBITDA due to a low base, and Shree may benefit from higher pricing in North India. From the mid-cap space, JK Cement as well as Birla Corp could outperform on the growth front. But let's wind this down then with a snapshot of the EBITDA estimates of all those companies, particularly the larger ones, and also a quick valuation snapshot in terms of an EV upon EBITDA basis. Well, that's the expectations from us. But let's get in Naveen Sahadev, the analyst, ICICI Securities, who joins us on the show. Hi, Naveen. Good morning and good to see you in. Well, Naveen, could you tell us what are your estimates in terms of cooling of cost? How much will cost cool off, on a per ton basis? And what does it mean for the industry EBITDA per ton?
Right. So, cost, I think on the variable cost front, there is only marginal room for further decline. I am not expecting any major drop as such. Maybe from a per ton basis, we would look at about, let's say 25 to 30 rupees per ton, kind of a sequential drop at best. Not looking at any major decline as such. And EBITDA per ton, that would lead to, on a sequential basis, something like 15 to 17% QOQ rise, which will also, in a way, have little bit benefit of the operating leverage as such. So a combination of price hike, some decline in cost, and then probably some operating leverage benefit should give an EBITDA per ton rise of about 15 to 17% quarter on quarter, or around 30 to 35% year on year.
Okay, got that, Naveen. So you're expecting, sequential improvement because of these factors playing out. But the question is that, are you expecting some of these tailwinds to continue? For instance, on the input side, are you expecting that to flow into the remaining part of this year as well?
Yes, in the sense that as we speak, there is further drop in the prices of both international pet coke as well as thermal coal. So those benefits will I think come in, if not March, but surely in the June quarter. So there is definitely some scope of further improvement in cost from a variable cost perspective. I think there is also an expectation that diesel prices could see some decline in the coming months, a few months maybe before elections. So that could also have some benefit. So cost, I think the headwinds are clearly not there. Let me put it that way.
Okay. What about tailwinds? But we're going to see some bit of decline in quarter 4. Will it be lower than quarter 3?
You mean to say the cost? No.
Yeah, cost, on the cost parameter. So after dipping in quarter 3, you're expecting it to plateau out a little bit?
Yeah, it will more be flattish because of those lag inventory impact, and then we'll see some respite in the June quarter, so to say. But again, Nigel, these are hardly needle movers. In that sense, they will not really help any significant change in earnings. Important is your demand and prices, which we need to be discussed more.
And how disappointed then were you by Ultratech's quarterly update? It came in at mid-single digits. Some on the street were expecting a little higher number. Was it in line with what you were working with?
No, it was definitely a tad disappointing, if I may say, because historically, if you look at it, your December quarter numbers are at least 8 to 10% higher versus the September quarter. That's the seasonality. What we have seen is more like a 2% kind of a number for Ultratech. So that's disappointing. And the other, I think, if Ultratech has posted a 5% kind of a growth year on year, I would like to believe the industry is more in the 3 to 4% range. So clearly demand has seen a knock, because first half we were growing at 11.5% or 11 to 12%, if I may say.
Naveen, we'll leave it there. Thank you very much for your time. And we'll speak again once we have the numbers, which will start to come in sooner rather than later. Markets have actually given up pretty much a lot of the gains. We're up about, just under 50 points. So we're at 21,665. Polycab is down 20, and the circuit was down, limit down, but that circuit is also open, the temporary circuit. It's down almost 21% now. Although now I think there is a bit of a back and forth which is happening. 10, 15, 20, and now, it's at least trading around those levels. We'll take a quick commercial break here. We'll come back. We'll put the focus on the commodity space, what's top of mind. Manisha is here to help us do that. Stay tuned.
welcome back. Market retaining bulk of its gains, a little bit of a shave off from the top on the Nifty. Now it's time to talk commodities. Let's see what's latest. We have Manisha joining in with all the details. Manisha.
Thank you for that, Surbhi. Well, I have metals on my radar and almost all of them are trading in the negative for 2024. December was a great month. I mean, we even saw all-time highs in gold and multi-year highs for many of those metals. But that's not how we've started 2024 with. One, it definitely is profit-taking with the kind of gains that you saw in the month of December. So as of now, we're trading at a 1-month lows for copper, 2-month lows for steel rebar, and a 3-week lows for the Singapore iron ore prices as well. It has to do with the weak China data. The PMI numbers came in that came in the previous week were on the weaker side. The markets are anticipating a lower growth going forward in the first half of 2024. And there is lack of a fresh stimulus or a consistent stimulus coming in from China. And that continues to weigh onto the markets. Apart from that, it also has to do with the inventories, which seem to be piling up on LME and Shanghai as well. Winters is anyways not a strong seasonal demand period. And that's yet another reason to watch. The strength in US dollar, which is trading at around 3-week highs, and this is ahead of the US inflation data that comes in today, is also keeping the markets jittery. The inflation data is something that we will watch out tomorrow as well from China. They have the CPI, PPI and the trade data coming in on Friday. So Chinese data tomorrow would take over all the other asset classes as well. I want to bring in a chart on that tells you on how we are looking at the markets there. Well, that's another thing. World Bank has warned of global growth slowdown for a third straight year in 2024, and that's continued to weigh on as well. So when you look at the nickel prices, we're trading at a 1-month lows onto this one, and we have seen a decline of 4% in 2024 until now. If you look at zinc, we're down by 4%. Aluminum is down by 7% as well. And all of these metals have seen a double-digit decline in the previous year as well, even after December saw such good gains. Copper prices did gain 2.5% in the previous year, but they've actually given up all of those gains in the first 10 days of January itself. Gold is down by 1.5%, silver is down 3.5%. So when you're looking at precious metals, base metals, ferrous metals, everything is started with a decline in 2024. What the street will now watch out for, though, is the inflation numbers, as I said, that come in from US today. And tomorrow is the China inflation and trade data that would give you further direction.
Right, Manisha, thanks very much for that. Well, it's time for a quick commercial break here. On the other side, our series Outlook 2024 continues. My colleague Lata will speak with Morgan Stanley's Chetan Iyer for his view on India, China and Japan this year. Stay tuned.